Let me share an overview of NewRiver and explain why we believe our current position represents the strongest investment case we've had in more than a decade. I'll start with a quick snapshot of who we are and what defines our platform. NewRiver is the UK's specialist REIT focused on essential and value-led retail. Today, our portfolio includes over 70 UK assets, a mix of community shopping centres and retail parks, totaling £2.3 billion in assets under management. We operate with industry-leading metrics, 96% retail occupancy and a 91% tenant retention rate. Our income profile is one of the most attractive in the sector, with a dividend yield of over 8.5%, fully covered and underpinned by a BBB investment grade rating and a stable outlook. Our strategy is straightforward and proven. Deliver long-term resilient and growing income returns through convenience-led, needs-based retail. With that foundation in mind, let me walk you through our investment case. Firstly, the retail market is in its healthiest position for more than a decade. Secondly, our operational platform continues to perform exceptionally well, driving high occupancy and strong leasing momentum. Thirdly, we provide an attractive, fully covered dividend, now yielding over 8.5%. Fourthly, our shares trade at a circa 25% discount to net asset value, despite stable valuations and asset sales near book value, offering an extremely attractive entry point. And finally, we have a strong pipeline of capital-efficient growth opportunities. To understand why this opportunity exists today, let's look at what's happening in the broader retail market. The UK retail environment has shifted decisively in our favour. Consumer spending remains resilient. Omnichannel retailers continue to win share over pure play online. Vacancy rates across core sectors are declining, highlighting the recovery of physical retail. Retail warehousing remains in high demand and shopping centre liquidity is returning. Investment volumes are rising, which indicates renewed investor confidence in our sector. For NewRiver, these dynamics support rental growth, operational strength, and valuation resilience. And this improving backdrop is directly reflecting in our operating performance. Our operational performance continues to be one of our strongest differentiators. Retention rates and occupancy remain extremely high. We're seeing positive rental growth momentum. Our leasing activity over the past 3 years shows healthy rental CAGRs across both shopping centres and retail parks. Strong operations translate directly into sustainable income, and that leads into our dividend story. We offer one of the highest quality income profiles in the sector. Our dividend was 6.5 pence for FY25, and market consensus is for this to rise to 6.7 pence for FY26, delivering a fully covered dividend yield of over 8.5%. Our dividend is sustainable, predictable, and underpinned by stable recurring income. Income is one part of the story. The other is valuation, and that's where a significant opportunity exists. Despite stable valuations, consistent earnings, and asset disposals close to book value, our shares continue to trade at a circa 25% discount to net asset value. We've now delivered 5 consecutive halves of stable or improving valuation. Investor sentiment towards the direct real estate market is improving, and capital markets liquidity is returning. As the sector continues to recover, we believe our discount will narrow, creating significant upside potential for investors. Alongside this value opportunity, we also have a strong and disciplined growth pipeline. We have optionality across the key physical retail channels, local community-led shopping centres, destination shopping centres, retail parks, and regeneration projects. Our capital-light partnerships allow us to scale without balance sheet pressure, generating fee income and enhanced returns. Where direct investment makes more sense, we have the balance sheet flexibility and discipline to pursue accretive opportunities. Every decision is anchored in clear risk and return thresholds and strict financial discipline. So let me summarize everything. We continue to deliver high occupancy, strong retention, and stable long-term income. We offer an attractive, fully covered dividend of over 8.5% and have a proven track record in asset acquisition and integration. And why now? Because we're at a unique inflection point and the market is turning. Retail real estate is returning to growth. Valuations are stabilizing. Investor interest is rising. And our shares trade at a meaningful net asset value discount. Combined with multiple capital light and balance sheet opportunities on the horizon, this creates a highly compelling entry point for investors. Thank you for listening.